If you've seen anything in the news lately, or you happen to open up insurance renewal or anything related to your insurance policy, you might have seen some different changes that have been happening in the industry right now. The truth is, the insurance marketplace is a little crazy right now, so we wanted to take a little time to just hop on here and talk about it. Alan, what are we seeing out there right now?
Well, right now, and one thing no one's ever accused the insurance industry of being is quick to implement things and do things. And we're seeing the direct effects of what has been happening in the broader marketplace that we've all been experiencing, with higher costs to build things, higher labor rates, and access to parts and so forth. And the industry has really started to see that explode really over the last year. The industry as a whole lost $28 billion last year.
Yeah, $28 billion.
$28 billion, and they're on pace to do that again this year, if not exceed that. So what we're seeing in the broader marketplace currently is the various carriers are starting to slow down on what they want to write, and they're getting very tight about the things they currently write. And you're all seeing that every day with your renewal increases and so forth.
What do you think on average in the state of Vermont? We're a little more isolated in Vermont, which is helpful, but what do you think on average, or at least the span, that we're seeing as kind of the standard rate of premium increases that we're seeing on policies so far this year?
Yeah, and it's been all over the place, and we are seeing at least 10, if not 15, sometimes 30% increases. As you noted, the Vermont marketplace has historically been pretty isolated from these larger events, but that's flipped. Over the last year, Vermont has been hit hard, and hit hard in ways you may not anticipate. Large windstorm, December 23rd of 2022, that started the year off in a rough spot for a lot of companies, led right into a polar vortex freeze-up event in February that was one of the largest claim events in the history of the state.
Yeah, coldest day in 100 years.
Yeah, right into all the flooding issues you saw. And I know what you're going to say, flooding's not covered under most policies, but there are still backup and drain coverage, there are vehicle coverages and so forth that all hit these carriers at once. So we're starting to see that. Another impact that we often don't talk about that does take the broader market and bring it right down locally is all insurance companies buy what we call reinsurance. So that's insurance that insurance companies buy against large events. Those are important to help insurance companies stay financially solvent through large hurricanes and those type of things. With higher interest rates, reinsurance contracts have been harder to renew because, one, those contracts all got hit with big events last year, the hurricanes, the wildfires. You can think through a lot of those activities we've seen in the news. And then you couple that with higher interest rates, there's better places for investors to earn money. So we're seeing that that marketplace is very tight, and a lot of our carriers have experienced significant reinsurance cost increase that are being passed along to the consumers. So yeah, we're certainly seeing 15 to 20, maybe even more than that, 30%, sometimes in the high end, even 50% increases, which in our marketplace is crazy. That's very Florida, very California-ish. That's not something we experience. Those markets right now can't even get coverage, so we're not in that place, which is really good. But we are seeing more, and that's really where the value of our collective team comes into play.
Yeah, and you touched on this a little bit when you were first getting started, but the process for an insurance company to raise rates is a long play. It's not something that happens quickly. Can you touch a little bit on what they kind of go through and sort of that timeline?
Yeah, that's a great point. So what you end up seeing on the insurance carrier front is a number of things. First of all, the day they decide they need to do the increase, they're looking at their math. They're seeing that, hey, we need to start raising more premium to offset losses. They file with the state of Vermont and they say, we want to take X percent increase. Let's just say it's 10%. State of Vermont's going to review that and approve it. If the state of Vermont has any questions, it can be a slower process. Right now, we're hearing that process can take anywhere from a month to 6 months, depending on questions, to get that rate increase approved. So that's 6 more months the insurance company's living with potentially 6 more months that insurance company's living with that low rate. Then they've got to roll it out. So they got to go update their computer systems, roll it out to the agents so we know it's coming. That often brings another 45 days type lag for that rate actually starts hitting the marketplace. And then remember, when it hits the marketplace, it's showing up as a renewal. You're getting that renewal at least 45 days ahead of your effective date. So that's when that first bill's due. If you happen to be someone that pays monthly, that means you're paying every month after that bill shows up. So now you're potentially 18 months to 2+ years down the road before the insurance company has actually seen that money hit their books. And that's why you see it take so long for some of these things and the insurance company to catch up with what we've all been experiencing every day in our life, as it takes them a while to catch up on these rate increases.
Yeah, and I think like there's always this sort of perception that a company's looking to jack their rates up, and it's something that can happen quickly. But as Alan kind of described, this is really a year process where they have to go and send it to the Department of Insurance and get approved approved by the insurance commissioner, and it's a regulated industry. And sometimes I've seen examples where the Department of Insurance came back and recommended a company even take a little more increase based off of what they were seeing. Now that insurance companies, they can push back on that, but it is something that happens out there. It's definitely an evolved process with our regulators in the state.
Yeah, and to build on that a little further, insurance companies in general, yes, there are some for-profit entities out there. You see them advertise on TV all the time. But the ones that we deal with mostly, you'll see if you look at their names, they've got cooperative, they've got mutual, they've got those type of names in there, and that is because they are by design for the policyholder. So they're not looking to make money hand over fist. Most of these companies have a goal of running what we call a 97% combined, which just means they're trying to make 3%, basically what comes in versus what goes out, plus their expenses, make 3% so they can grow their surplus a little bit in case there is a large event that they have to contribute to. And that's what they're trying to do. So when we see them taking rate, it's because they are running at a loss currently, and they're trying to get stabilized again and get back to a point where they're just barely making a little bit of money so that they can keep their business solvent.
Yeah, and so I think what kind of comes back to is, in this current marketplace, it's more important than ever that you work with a trusted, independent insurance agent advisor. We have insurance companies that are coming into the office regularly, and Alan and I stay on top of, all the current trends. It's important to work with an independent because we have multiple options, multiple companies. So if one company happens to be a company that's looking at more like 30% rate, we can help you have that conversation of, maybe we should look at some of these other companies. And it's something we've been doing a lot of lately.
Yeah, if you look at really what Drew and I spend a lot of our time doing, it's trying to understand the insurance landscape. Because the last thing we want to do is place a client with a company that's going to be taking large rate increases in the next year or two. We also want to make sure that our client base is seeing a stable performance from their carriers, and that's important to us. And like Drew said, we work hard because we have a lot of different options, and it lets our team provide some variabilities to our clients so that they can then make a choice that works well for them. They're not pigeonholed with just one carrier. And then we can also sit down and have that conversation that says, hey, we've seen what 15 companies are doing. I know this increase is a little painful right now, but we think this company knows what they're doing, and you're going to be better here for the next couple of years because they're doing the right actions versus, hey, I know this is the hot hand today, but we can tell that they're going to have to take rate over the next 2 or 3 years. So we move you, you'll feel great for a year, and then you're calling me next year wondering why you just saw a 50% increase or something crazy. So we do try to monitor for all that and help guide our clients through that marketplace, because that's where we think we really differentiate ourselves on a daily basis.
Yeah, and an underrated piece of things that people don't always think about is your reputation as a client in the industry. And companies do, with all the technology we have, they do start to recognize people that are looking to shop and change every year. It's important that you're working with somebody to help you, through that process. And then another big piece of it too is maybe we should touch on a little bit is with new underwriting guidelines. So even if we moved you to a certain company right now, a lot of their guidelines are pretty strict, and they're doing things like full property inspections and making recommendations for things that might need to change, which could potentially cost some money.
We've focused this on rate increases, but another thing that carriers do to try to curtail losses is prevent losses. That's a big part of what they do. It's a big part of what we try to do here at the agency. So what you do see in times like this is they get back to what we call very hardlining underwriting discipline. They want everything to be picture perfect, frankly, because they know that will prevent a future loss. So if you've got paint peeling somewhere, you've got a deck that maybe needs to be replaced, you got handrails that are weak or not existent at all, or a fence, you don't have a fence around a pool. There's a lot of things that they're now looking very closely at, and we can't get exceptions to. Normal market conditions, I can get the occasional exception. Today I can't. So we could move somebody, save them $200, and then find out that they've got a $3,000 contractor bill because they don't like some shingles on the roof.
Yep.
And we've seen that play out. So that's the other thing we're trying to weigh in the back of our mind, and that's we'll have that open conversation with you. We'll say, hey, look, you know your property better than we do. Do you have a surprise or something hiding somewhere that you know about that they might find on review that you're ready to address, or maybe we just leave it where it is and we get through this renewal and we work till the market's a little more favorable.
Plus longevity is an important piece of the equation now. If a God forbid a certain claim happens or something happens, if you have a history with a carrier, especially if it's a claim-free history, they're going to look more favorably at that, down the road. Whereas a lot of companies now are drawing a little harder lines. So if you were new to that particular company, me and you had a water claim or something, they might non-renew this, coming next year. They wouldn't do that necessarily to somebody with some longevity. So longevity is still an important piece of the equation. All right, I think kind of another cool piece or another important piece to this equation is, what happens to companies if they don't raise rates?
Yeah, so the bottom line is if these companies can't get their rates back where they need them, there is a potential that they can go insolvent, which creates a lot of churn for everybody. And that just basically means they can't pay claims. There are some backstops the state has in place against that, and there's nobody in the Vermont marketplace that we're aware of today that's even facing that, but we do see that playing out on almost a weekly basis right now in markets like Florida, California, Louisiana. So it is something that's a legitimate problem that insurance companies have to be aware of, is keeping their financial ratings where they want them. And then you start getting into a lot of real boring insurance stuff, but you talk about like AM Best ratings and things like that. That stuff that Drew and I monitor all the time for our carriers. All of them are in good, healthy positions. But again, they are being watched by these rating companies to make sure they're taking the appropriate actions to stay solvent, frankly, and be able to pay future claims.
Yeah, and Alan kind of touched on it a little bit, but even like a state like Florida, I think it was either 12 to 15 companies over the past year and a half have gone insolvent and pulled out of the state. We have seen some instances of companies that have left the state of Vermont. Kemper Insurance was one of them, somebody that we had worked with for a very long time, and they just they couldn't find a way to write in our state in a way that made sense, and so they decided to leave. So we're not necessarily isolated from it, but it is much lesser than what we're seeing in other states. All right, Alan. So let's give people a quick summary, the 60-second overview for the too long didn't read type of folks, and then what are we doing as an agency to help mitigate this for our clients?
Yeah, so a quick summary on it. We know the insurance marketplace is in a state of flux. You can type insurance into Google right now, and there's tons of articles out there that explain the why. The bottom line is insurance companies are losing money, lost roughly $28 billion last year. They're going to lose more this year. They're trying to get their financial picture straightened out, and we have to deal with it every day and work through it. And we're here to help guide our clients through that. So when we see these increases come out, our team is monitoring them, and we're reaching out to our clients, if we haven't before the renewal, to set up a review meeting to make sure you're getting all the discounts, talk through some options. And if we need to, we'll look at, do we stay with your current carrier or do we go somewhere else with your business? But that's what we're trying to do, is help navigate these waters. We know they're choppy. We know they're rough. Our team is here for you. The only thing I ask, and I'm sure Drew would echo this, is our team has been navigating these waters now for 6 months, and they probably got another 2 years ahead of them. So be patient with them. Be nice to them. They don't get to set the rates. They don't get to do it, but they're here to help guide you through it. And it's choppy water right now, and we're battered and beaten a little bit, but we're here for you, and we're going to keep doing what we do.
Yeah, as Alan kind of said earlier when we talked about what happens during a rate increase, but you might have noticed there was a key component of that wasn't in that equation, and that's frankly insurance agencies. We don't have anything to do with setting rates, right? We just can help you navigate the scenario that's at hand, due to what these, companies have to do to, remain profitable in the state.
Yeah, and just to build one more step is, and these companies, they're doing what they're best too. A lot of them are key partners. A lot of them have been around for 100 plus years, and they want to be around for 100 plus more to be here. We've been very fortunate in Vermont to have a very stable, calm insurance marketplace. We are seeing a little bit of turmoil right now. It will settle down. And yeah, we're going to have to deal with a little bit more of a new normal. But if you talk to any of your friends that live in Florida or on a coast, what they're dealing with for premiums, it would make you fall out of your chair. It's not uncommon to have a $10,000 homeowner's premium, and we're getting excited about $1,000. So there is some perspective that needs to be laid out here too.
Yeah. Well, awesome. So the goal of this is we wanted to just talk a little bit about the marketplace and some of what we're kind of seeing currently and where we kind of think things are headed, and kind of our plan for how we're dealing with it. If you're a current client of ours and you want to schedule a policy review, don't hesitate to reach out. We'll set you up with the team, and we can walk through all the coverages and options that you kind of currently have. If you're not a current customer and you're not sure what to do, don't hesitate to reach out, and we'll set you up with somebody as well, and we can help you navigate the waters. One of the things that Alan and I have always said from the beginning is, we don't have the best option for you. We'll be the first ones to tell you. So we're happy to give an objective review of things and shoot you straight.